In this video, I am going to discuss about expected values. Expected values are a single weighted average of all the possible outcomes for a given scenario. This method is associating risk in the form of probabilities. For each outcome, probabilities are assigned based on the possibility of the occurrence of that outcome. Probabilities for an outcome ranges between 0 to 1. 0 means 0%, 1 means 100%. 0 and 1 are the decimals we are going to use under expected values. 0 indicates there is no probability of occurrence, and 1 indicates there is a probability of full occurrence. This is the expected value formula. We can denote expected value by EV. EV equals to sigma x times P. X is the outcome. P is the probability of that outcome. So we have to calculate the summation of all the XP values. Let's do this example. X company is ready to launch a new product to the market. Management team is considering a price for the new product. And how will the market react to this price? They have estimated all the possible outcomes for $100 price per unit as follows. Calculate the expected value. This means management team is considering different scenarios for different prices. Here they have given the estimated outcomes for when the price is 100. So sales units I have given. These are the outcomes. There are 5 outcomes. What we have to do is we have to calculate the expected values. And remember that when it comes to expected values, we have to consider all the possible outcomes. So these are the all the possible outcomes for price level of 100. So this is the expected value formula. Sigma x p. Here the x will be the sales revenue. P is the estimated probability. So now let's calculate the x value. Remember that x can be any value. It can be units or it can be currencies. In this example, it is the currency value because we are considering the revenue of this product. So we can calculate the sales revenue by multiplying the sales units by the unit price. Unit price is $100. So we can multiply this by 100. So the sales revenue is 120,000. For the second outcome, also we calculate the sales revenue. For the third outcome, for the fourth outcome, and lastly the fifth outcome. Now we have the x value. Now we can simply multiply the each outcome by the respective probability. So the expected value for the first outcome is 120,000 multiplied by 0.3. When a project considers all the possible outcomes, the estimated probabilities should equal to 1. So these probabilities should equal to 1. Let's calculate and see if the summation of these probabilities are equal to 1. 0.3 plus 0.2 is 0.5, 0.7, 0.8, 1. So they have considered all the outcomes. This 1 means 100%. These probabilities also can be given as percentages like 20%. When you are calculating, you have to convert these percentages into decimal values. Then only multiply these by the outcomes. So this equals to 36 Likewise, now we can calculate the expected value for each outcome. So these are the expected values for each outcome. Now we have to calculate the total expected value, which is sigma x p equals to 99,400. This is the expected value for this scenario, which means if the company decides to go with the price of $100, the average sales revenue will be 99,400. Remember, this is an weighted average value. Expected value is an weighted average value. This is not a realistic value. So this is the basics of expected values technique. Now let's do an example. Select the best product to launch based on the expected values, assuming both products has the same costs, which means both products have the same cost. If the sales revenue is higher, that product will make more profit. So what we have to do is we have to calculate the expected values for each product. Expected value equals to sigma x p. So they have given the sales revenue and the estimated probability. So we can calculate the expected values for each outcome by multiplying the sales revenue by estimated probability. Let's see whether this question considered all the outcomes for product A and B. We can check that by adding all the probabilities. If it is 1, it means all the possible outcomes have been considered. So 0.3, 5, 7, 8, 10, which means 0.1. They have considered all the outcomes. Let's go to the product B. 0.4, 5, 6, 7, 1. For this also they have considered all the possible outcomes. Now let's calculate the expected values. These are the expected values. For product A, the expected value is 748. For product B, the expected value is 925. So what product we should choose based on the expected values? We should select the product B because it has the highest expected value. Think about it. We are considering the sales revenue for product A and product B. Do we need the sales revenue to be higher or lower? We need the sales revenue to be higher. So we select the highest expected value because the expected value is a weighted average value. So we will select product B based on expected values. These types of tables are called as probability distribution, which means these tables include all the possible outcomes for a given scenario and the respective probabilities. Now let's do this example. A company is about to manufacture a new product and there are two production processes available. The production costs for the two processes are as follows. This is process 1 and this is process 2. They have given the costs and the respective probabilities. All these data are the same as previous example. So now we know the expected value for the first table is 748. Expected value for this table equals to 748. For the table B, 925. Expected value 925. Now what expected value should we select? Look at the data given here. They are giving us the cost. So what do we need? We need the lowest cost possible. So we select the lowest expected value, which is this. So we select the process A. When it comes to cost, we select the lowest expected value. When it comes to return, we select the highest expected value. Now let's discuss about pros of expected value method. Easy to calculate. As now you know, it is a simple calculation. Considers risk for each possible outcome as a probability. Now we know the probability values are indicating the risk for each outcome. So this method considers risk for each possible outcome. This is a pro of this method. Decision making is easier since a single average is calculated. As we did in this example, based on this single value, we made the decision to select the process A. This is relatively simple when it comes to decision making. Suitable for recurring events. This means the given scenarios are recurring over and over. The reliability of this method will improve because we are calculating an average. Now let's discuss about cons of expected value method. Does not consider the risk of dispersion around the expected value because we simply calculated the weighted average value. We did not consider how the possible outcomes are varying around this expected value. Think about it. We calculate an weighted average, which means it lies in the middle of a data set. There are data above this line, there are data below this line. We did not consider how these data lying around the average line. This is not suitable when it comes to decision making. We have to consider how these outcomes are varying around the average value. Actual outcome may not be the same, which means expected value is an estimate. And also this is an average value. In the reality, this will not be achieved. Estimated probabilities are usually subjective. Think about it. Let's go to the previous example. This one. The company is ready to launch a new product to the market. Management team is considering a price for the new product. The probability is calculating the management team. So the probabilities can be subjective. Subjective means the opposite of objective. Subjective means it can be changed based on the person. Objective means it does not change based on the person. So the probabilities for the calculations can be subjective. This is a limitation of expected values. Not suitable for one-off decisions. One-off decisions are decisions that are not taken regularly. As we discussed here, this is suitable for recurring events. Expected value method is not suitable for one-off methods. Now let's discuss about the standard deviation. This is the measure of volatility of the possible outcomes around the expected value. Standard deviation compares all the possible outcomes with the expected value. Then calculate an average volatility around the expected value. Higher the volatility, higher the risk. Lower the volatility, lower the risk. As I said earlier, expected value is an weighted average. This means the value will be lie in the middle. There will be values above the average and there will be values below the average. Now what we are going to do is we are going to calculate the average of these variations around the expected value. This is called the standard deviation. If the volatility is higher, it will be riskier. If the volatility is lower, it will be lower risk. This is the formula to calculate the standard deviation. SD denotes the standard deviation. This equals to square root sigma p multiplied by x minus x bar into the power 2. This P is the probability of the outcome, X is the outcome, X bar is the expected value. So we are calculating the difference here around the expected value. So sigma denotes the standard deviation also. This X bar is the expected value. This is also called the mean value. Now let's calculate the standard deviation for previous example. So the standard deviation equals to square root sigma p x minus x bar into the power 2. First calculate the p x minus x bar into the power 2 for all these outcomes. Then take the summation of these values. Then take the square root. So for the first outcome 0.3 x is 1200 minus expected value we calculated earlier. Here 748. So the expected value for this is 748. For this probability distribution, the expected value is 925. So 748 into the power 2. For the second outcome, 0.2 500 minus 748 into the power 2. So these are the standard deviations for product A and product B. You are not required to do these lengthy calculations in your exam. You have to have the understanding of how to calculate the standard deviation and what is the standard deviation means and how to make decisions based on expected values and standard deviation. So the standard deviation for product A is 387.08, for product B 764.44. Both of these are currency values. This standard deviation means, let's say for product A, the weighted average or the expected value is 748. So this is the level of 748 outcome. So all the other outcomes are varying on average above and below 387. This is what we have calculated. This is the standard deviation. This means the outcomes are varying above and below the expected value. So higher the standard deviation, higher the risk will be. For product B, this is the weighted average or the expected value we calculated, which is 925. This is the level, and below and above all the other outcomes are varying 764, 764, which means possible outcomes are varying around the average value by 764. And this is very important. Standard deviations can only be compared if the probability distributions have the same expected values. If the expected values are different, coefficient of variation has to be calculated, which means we cannot compare this 387 and 764 because these two products have different expected values 748, 925. We cannot compare the standard deviations for different expected values. Let's say both product A and B have a same expected value, let's say 800. Now we can compare the standard deviation, which means now we can make decisions based on the standard deviations we calculated. If the expected values are not equal, we have to calculate the coefficient of variation. This is also called the relative standard deviation. Coefficient of variation, relative standard deviation. Probability distributions with different expected values cannot be compared with their standard deviations. So we have to calculate the coefficient of variation. This equals to standard deviation divided by the expected value or the mean value. Let's calculate the coefficient of variation for the previous example. So product A, the coefficient of variation equals to standard deviation 387 divided by the expected value 748. This equals to 0.52. 2. This is the coefficient of variation for product A. For product B, coefficient of variation equals to standard deviation 764 divided by 925, which equals to 0.83. Now we can compare these two values. For product A, the coefficient of variation is 0.52. For product B, the coefficient of variation is 0.83. So, the product B is more riskier. Now let's read this table. This will summarize what we have learned so far. So they have given three projects: Project A, Project B and Project C. Expected values are already calculated and the standard deviations are already calculated as well. Let's say these values have been calculated for returns, or let's say revenue, or can be for profit. Which project would you choose based on the expected value? We select the highest expected value project, which is project B. Now let's say these expected values have been calculated for costs. So what project would you choose based on the expected value? You select the lowest expected value project, which is project A, 4500. They have given the standard deviations as well. Based on these standard deviations, can we make a decision which project is riskier and which project is least riskier? No, we can't, because the expected values are not equal. So what we have to do is we have to calculate the coefficient of variation for each project. So this will be 700 divided by 4500, 1020 divided by 9000, 200 divided by 7000. So these are the correlation of variations. Based on these values, now we can decide which project is the most riskier and which project is the least riskier. So project A is the most riskier because 0.17 is the highest value among these correlation of variation, and project C is the least riskiest. To summarize this video, we discussed about expected values. Expected value is a single weighted average value for all the possible outcomes for a scenario. If the expected values are being calculated based on the returns, we will select the highest expected value project. If the expected values are being calculated based on cost, we select the lowest expected value project. Then we discussed about the standard deviation. Standard deviation is the volatility of the possible outcomes around the expected value. Higher the volatility, higher the risk. We cannot compare the standard deviations for different expected value projects. We can only compare the standard deviations for same expected value projects. If we want to compare the risk of projects, then we have to calculate the coefficient of variation. If the coefficient of variation is higher, the risk will be higher. Thank you for watching. See you in the next video.